Folks, in video number 1, we talked about existing home sales and their blowout number. Thursday morning, the day of this recording, we actually got new home sales, which surprised to the upside as well. And I think we need to talk about KB Homes, because KB Homes, at least in my mind, serves the first-time home buyer. And, oh, by the way, is very concentrated in the West Coast, who has seen some price drops. So they just had some earnings release and an earnings announcement. In order to have these conversations, we bring on the one and only and amazing Lance Lambert. How you doing, sir?
Yeah, thanks for having me on Housing. And we got Leo here.
Yeah, the audience loves Leo. You are going to be a fan of the channel, Leo. How you doing, buddy? Hi.
Putting him back
down. There you go. The up and down. Yeah. So where do you want to start? You want to start the new home numbers that came out today? You want to start KB Homes? Where would you like to go first?
I think I think the big picture. And the big picture is that last year we saw a historic mortgage rate shock. Really like an 81 almost style, not an 81 in number. It wasn't 18%, but moving up from 2-3% to 6-7% math wise, in terms of the change to the new payment for borrowers, was a shock like 1981. Correct. And we saw a sharp reaction. Transactions moved down very quickly last year. And on the new home side, builders who had built up quite a backlog during COVID because prices were very high, they could charge whatever they wanted. There was essentially an unlimited amount of demand, and they built a very big backlog because there was a slowdown in production, met with their wanting to sell a lot of homes because there was just a lot of demand there. And so they immediately had to address this backlog. And the fact that, this mortgage rate shock meant a lot of people in their backlog were no longer eligible for the mortgages that they were sold, right? So it wasn't just people getting scared. It was they were actually moved out of the market by the shock.
Correct.
And so builders had to act very quickly. This act very quickly, what they do varies so much by not just builder, by not just market, but by community. And some builders, we have seen prices cut. We have seen incentives that have been very aggressive. The rate buy downs for the 2-1 buy downs, but there are some that go many, many years past 2 years for the rate buy downs and cost the builders quite a bit of money. Builders obviously would rather do the rate buy downs and these other incentives because the people in their backlogs would be like, hey, you cut their price, what about me? And they don't want a lot of people dropping out of their backlogs. Something very counterintuitive is that KB Homes yesterday on their earnings call said that they were most likely to cut price in the communities with the fewest people in backlogs. So in theory, you would think a lot of people in your backlog and people are dropping out, you have trouble, cut price, right? No, they're cutting prices most where there's the fewest people in the backlog because they don't want them all rushing to them. So It makes no sense. But it does make sense if you think about it from the builder's perspective. Yeah. But on face, you would think where the most people are canceling homes, that they would cut prices the most. It's not always the case.
Yeah, I think what you're seeing there is what I think they're saying, and you correct me if I'm wrong, is in those communities with high backlogs, that's where they're going to focus on rate buy down. So they get a call from Joe Blow, who's contract number 1, 2, 3. They want to cancel. They say, hey, why do you want to cancel? Well, I can't afford it. Well, what if I did this? What if I did that? But if there's a community with, 2 backlogs, they don't really care about cutting price because they're going to cut price because they got to get more demand and they're only risking 2. So yeah, I think I know why the builders are doing that. Does that make sense?
Yeah, it does when you think about it from that perspective. Absolutely. And so what we're seeing now, though, is we are seeing cancellation rates drop very quickly, a very fast deceleration, and you could even say normalized for some of these builders. John Burns Real Estate Consulting, they poll every month builders. Their cancellation rate for October, 24.6. In October of last year, it was 10.8 or 7.3. This October, 10.8. So essentially from 7% to 11 year over year. That's not bad.
That's not bad.
In March of last year, the percent was 8%. Rick tells me, Rick Palacios over there, their director of research, he tweeted to me when I tweeted this yesterday, that the March number looks like it's even going to be lower than the February number. So February was 10.8, and last year was 8 for March. There's a chance we're getting really close to last year's rate for March, which was a barn burner of a month. And so this is why right now I'm very high alert on builder stuff, because there's the possibility that the deals are evaporating.
I'll say it differently. They are evaporating. I have evidence and conversations weekly.
So KB Homes said on the call, they're still doing incentives, and they said that Boise is adjusting still. But they said the incentives, the buy downs have been successful, but they also said they're doing fewer buy downs now.
Yes.
And that was important to hear. And so now that you're seeing the builders, and this kind of takes us full circle back to the beginning of the conversation, now that they're moving through the mortgage rate shock and they're at the point where cancellation rates have fallen and they've started to meet the market, and now they can sell homes, their backlogs are going down. They're not having big increases in homes that were sold and people falling out because the mortgage rate shock's behind them. And the people in backlog, in theory, shouldn't lose it if mortgage rates go higher, because we probably already met that peak. Yeah. So long-winded way of saying that, yes, there's a very good possibility that deals are, the window is going like, and that's why, yesterday when I think you had tweeted something about, new construction stuff. That's why I just wanted to point out, hey, those markets in particular, Salt Lake City, Phoenix, they are down. They have seen a correction, but it's a question of like, how long does this window last? With Ally Wolf saying that, what was it, 20% raise prices in February?
Yep.
And 5% cut. And I know what those numbers were in November, December. It was quite the opposite.
That was, yeah, exactly.
And I need to get a napkin for Leo. He's got chocolate all over his hand.
No worries.
To make with prices for builders is to be careful because of mix. So KB Homes on the call, they said, their average price was absolutely affected by mix. And what's happened is, so think about list prices. A list price can get skewed upward in a market shock scenario, because what happens is the expensive homes sit on the market longer. They become a bigger part of the mix, right?
Exactly.
And sales prices go down further than reality, because the lower priced homes become a bigger percentage of the sales.
That's how it's what median is, the middle. It is not the average. Correct.
So in a market scenario, in a market shock, in a housing downturn, list prices get moved up probably more than reality. Median sales prices get moved down more. The builder's number gets moved up more, the average ones, because they end up reselling some of the expensive homes more than were, so they stick around. And that's why I really like, and we have to wait for them, are the repeat sales indexes and the value indexes, because they're trying to adjust for market mix, especially the value indexes produced by like Zillow and John Burns Real Estate Consulting. And then Schiller's a repeat sales index, which means they're taking homes that sold before and looking at what they sell for now. And they have like this 40-page methodology. So I always think that, I like those ones. And if the Schiller is down 2.7 from peak for existing, I think what that tells us is that new's down more than whatever 2.7 is. Because, but we don't have great data on new home prices. Census isn't good home price data. The best you can get is Zonda, Zellman and Associates and John Burns, who do some of their proprietary measurements. But even those aren't great. John Burns has new down 10, but that's including incentives.
So including incentives, which is not really a price, it's an expense.
Yeah. So, but I know that it's more than 2.7, because
I think that's fair.
No way that new is down less than existing.
I would agree with that. There's no question.
Yes, but not crash. Not
no.
Crash. Now, some of these markets, the move down from the top was very quick and abrupt. I think that's so. So what Ali Wolf has said that builders have decided to do this cycle is not do what they did in the '08 cycle. The
It's
'08
very different.
cycle
Yes.
was we're cutting 3%, we're cutting 4%. Let's see what happens. And then everybody who is a new home buyer decides,
I'll just wait. I'll just wait.
wait. And
Exactly.
so you create a deflationary environment for price. Builders
Exactly.
this time waited. They kind of figured out, okay, what are we going to do? And they made a plan and they went out and just met the market.
Yeah.
And now you're not seeing things move down like that. So the buyer out in the environment right now is realizing in real life or like real time events that, oh, things have changed. It's no longer moving down. And so you're stopping yourself from that deflationary consumer mindset. And I think that's also an important stage in going through this shock is, we could have a situation right now where that builder number that came out today was a much lower drop in activity because they fought bringing prices down, or they brought it down just a little bit. And you could create an environment where the total drop in price and the total amount of incentives offered from builders would have to be much more because they waited too long. And so when I see some of these, because after yesterday, and then I kind of saw some of your comments, I went out and decided to take a look at what these YouTubers are saying about new home. And
oh no!
I spent some time watching it and a little disturbed about how dramatic they act about it.
And you didn't hear that new homes are crashing. It's the new thing because they were wrong about existing home sales, so they had to create a new topic.
There are deals out there that
of course
there were, but the band-aids got ripped off. And so it's like, how many more band-aid,
there's no inventory. They only sell it once. They don't sell it over and over again.
Yeah.
It's mind-boggling.
They've ripped the Band-Aid off. And obviously I'm not speaking about every market.
Oh, of course.
Phoenix is its own thing. And so Boise, they said it's a period of adjustment. But I think if I was a consumer looking for a home,
a new home. Yeah.
That relative to existing, you might get a better deal.
Yeah.
Relative to the past in terms of the balance between existing and new home prices and the deals. Sorry, Leo's getting into more stuff.
That's right. I've got just one more.
So now I'm going to probably spend a little more time the next week or so being a little more vocal in my outlets about the new home side of the market. Because, it does look like that window is closing and that there are some relative deals out there that people might want to take a look at.
Yeah, I think the window's closing. You probably have 2 or 3 more months, again, community by community, but it doesn't hurt to ask. I just want to share one more stat with you before we let you go and go play with Leo. Something I got from one of my millionaire experts each week who supports Seattle, aka King County, is, and she did the summary for February of 22 and February, because obviously it just closed 23. I'm just going to ask you a question. What do you think the average purchase price to list price was across all of King County in February of 2022? You have a wild guess?
So average from list price
to actual closed purchase price for all of King County. It's a Seattle area, so big area. February of 2022. February 2022. So last year.
Well, I know when I've seen this number before, a lot of times it's like 0.97 is a pretty popular one. So I'll say that, and I don't. So I'm guessing you're going to say it's more than
112%. It was the highest I've ever seen of any city I've ever looked at.
Yeah. So that tells you that's a shift, because the list are not expecting the market. Yeah, that's a shift in trajectory in the market, I would think. And
what we had was record low inventory. We had rates at stupid levels. We had a buying frenzy. All of these things going on. And now if you look at February 23 in Seattle, prices are down 15%. Well, guys, we got to pay for the sin of February 2022. So if you look at the graph of Seattle for 2022, February and March stand out like a sore thumb because there was just very unusual and I would argue unhealthy behavior.
Yeah.
Now they're going to show big downs, but by June it'll be back to normal. It's wild to look at.
Yeah, it'll be interesting to see what happens. You know, my gut has been that the market's like saying, and this is something I said before SVB went down. So
Yeah.
that could be a little bit of a wild card. But
Yep.
I had assumed that Seattle, San Francisco, and Los Angeles would probably rebound faster than the Vegas, Phoenix, Boise, Austin segment.
I will give you LA and Seattle. I will not give you San Francisco. I think there are unique environmental things going on that will make it a struggle for San Francisco.
Yeah, and so yeah, I could see that. The Phoenixes, Vegas, Boise, Austin are falling more in line with the traditional boom bust down cycle.
Agreed. Yeah.
That's what it looks like. And they had construction, and you have to have construction for an actual boom bust cycle. That's why I put Seattle, San Francisco, LA, which to me, those are just very, very high cost cities and very rate sensitive. To where if rates move up too fast, it creates that mortgage eligibility shock where people were already just barely affording the mortgages.
Correct.
To get into those markets. And so you create, and actually this raises another point, which is, why do fundamentals in housing matter anyway? Some people online will act like housing fundamentals are destiny. You're overvalued, you're going to have to go down, is how some people act. That's not how, and the reason that fundamentals do matter, though, is you take a market like Boise, overvalued by historical measures by 70%. Well, so what that means is a lot of people in your market, the locals, were probably already priced out, right?
Correct.
And you bring in this eligibility shock, or you bring in this mortgage rate shock, it essentially is like a credit tightening where so many people just lost eligibility altogether. So if you're really high or really detached from your fundamentals, you're going to be more vulnerable to a credit tightening scenario. Which I would call the mortgage rate shock a credit tightening in that way, that so many people lost the eligibility. But fundamentals aren't destiny. And home prices usually, when they get in line with fundamentals, do it through declines on the real basis, which is something we've talked about forever. So I think fundamentals matter the most when housing goes through a shock scenario, but we've kind of moved through the shock. We're kind of out to the other end. Now we're at a point where affordability is just very strained, and that's going to have an effect on the market the next few years. And it's not going to be the robust activity that we saw in the pandemic.
Absolutely correct.
So it'd be interesting to, I think now where we are is we're getting to the point where we need to just start talking about, like, what does this recovery in the next few years look like? Like, where can activity move to in a world where affordability is this strained? Like, how, at what level, at what point does the existing market start to kind of recover? I think on paper, some people are saying, well, from 4 to 4.5, that's a recovering existing market. Well, it's like, look at the new listings. This is a very strained market.
No, I look every day. I talk with people around the country. What you had in February and what goosed that number higher, which you can't repeat, is Q4 was really slow. So you had a little bit of extra inventory in January, which got gobbled up. I know dozens of investors who had 4 to 6 flips just dying on the vine in December. All of them got gobbled up in December or January, which became February closes. That inventory is gone. You can't sell a house twice. Once it's gone, it's gone. We are going to go down next month. It'll be 4.2 by existing. And I go back to video 1. We need to figure out how to unlock supply. And now we know it's not 6%.
Well, I think the best way of unlocking supply is the builders meet the market. They've done their adjustments because they had the margin to do it. They had those frothy pandemic margins. And now they can turn their focus more into expanding to the lower end of the market.
The first builder that goes hard on entry-level homes is going to dominate. Because again,
Oh,
existing home sales historically is 80, existing home sales, I believe, is 89% of the market. New home sales are 11 under all the transactions. We already know that existing is going to be down roughly 40% year to year from the peak. A new builder going hard on entry level is going to crush it.
yeah. And
Just
I think
crush.
some builders right now, I think they're trying to see what they can get land prices down to.
Sure.
Because we don't talk about that much, but there's been a correction on the land side. Builders really just were buying up so much land, and they pushed up those prices to very frothy valuation. So there's been some leveling there. And I think builders would be buying more land already these past several months, seeing that they are, in a better position with the market because buyers are kind of coming back. But they're waiting a little to see, hey, what happens here with some of the land
Oh, yeah, they
prices.
want to see. Exactly.
So
Lending, how
that's
tight it's
something
going to get on that.
I'm interested to see like what Ali Wolf and people like Rick put out about land the next several months. Like, how do builders start to react there?
Yeah.
And I think once they're starting to make moves and the markets like Vegas, Phoenix, and Boise, I think that'll start to be telling.
There you go. Well, folks, like I talked about yesterday, Ali Wolf is a great follow from Zonda. Zondo, what is it?
Yep.
I don't know how to pronounce it. What's it called?
Zonda.
Zonda. Thank you. She's a great follow. Ali Wolf, ALI Wolf, like the wolf. Lance Lambert, Rick. These are all guys I follow every day. I look at their tweets every day. Please give them a follow. Tell them you came from One Rental at a Time. I'd love to interview Ali Wolf someday. But Lance, you're here every Thursday. You and Leo. Where can people find you?
They can find me at News Lambert for Twitter, or Google Lance Lambert Fortune to find my articles.
There you go. You're being a great dad, Lance. We appreciate you. Leo, have a wonderful week. Take care, guys. Bye.
Chat soon. Bye.
Thanks.